Hello, everyone. Welcome to this discussion on taxation of alimony payments. Let's begin with the legal definition of alimony, which might differ from how you think of alimony. So, normally, you might think that people get divorced and maybe one spouse pays another spouse, and then these payments between the spouses is alimony. But alimony has a very specific legal definition and it might differ from how we normally think of it. So let's learn the legal definition. It says cash payments under a divorce or separation instrument that's not designated as non alimony. Now, that's an interesting way of defining something. And this is something you'll see not only in tax planning, but also in estate planning. That sometimes we'll say that the definition of X is that X is not X. And although that might appear to be funny, but it does serve a purpose. Here, they are trying to be comprehensive and then they're trying to make sure that the definition captures all possibilities. So, if something is designated as non alimony, then even though one spouse is making another spouse a payment, but because that's designated as non alimony, then it's not alimony. Again, it should be obvious, but they are just trying to be comprehensive here. Another requirement here is that spouses should not be filing joint returns for payments to qualify as alimony. Then spouses cannot be members of same household when these payments are paid if they are legally separated. Then there should be no liability to continue these payments after the recipient's death. That's an important condition. Please pay attention to that. And we have these payments should not be child support or property settlement. So please pay attention to all these requirements. Here, I want to focus on one payment that appears to be alimony but actually not alimony, and that's child support. And many students get confused by it. So please pay attention to this condition. Then non-cash property settlements, these are also not alimony. Rent-free use of heirs' property, that's not alimony. So maybe a couple gets divorced and then one spouse lives in another spouse's home rent-free. Now that rent-free benefit that they're getting, that does not qualify as alimony. Next, we have voluntary payments. If one spouse is making voluntary payments to another spouse after they get divorced, that's not alimony. And lastly, payments to maintain the pair's property, these are also not alimony. So again, going back to the same example, maybe a couple gets divorced and then one spouse lives in the home of another spouse and the owner spouse is paying the other spouse some money to maintain their property. Now, these payments do not qualify as alimony. Now, let's look at a specific example. The divorce decree states 6,000 per month total support until youngest child turns 18, then 4,000 per month thereafter. So here, what we need to understand is that this 2,000 reduction, that's tied to the child turning 18, and that makes that portion child support by default, and that 2,000 is not alimony. And so the remaining 4,000 qualifies as alimony. Of course, it needs to meet other IRS rules, but here, for the purposes of the CFP exam, we'll just simplify and we just want to focus on the distinction between child support versus alimony. Now, let's think about the tax treatment of alimony. This is something that's often tested on the CFP exam, so we want to pay a lot of attention to this particular rule. So what happened is there was this Tax Cuts and Jobs Act, and that changed the tax treatment of alimony. If a divorce was executed on or before December 31, 2018, we will just refer to these incidents as pre-2019 agreements. So for these divorces, for the pair, the amount that they're paying as alimony, that part is deductible for AGI. That's their above the line deductions. Deductible for AGI and above the line deductions mean the exact same thing. So this is the part in the formula where that rule becomes applicable, because these alimony payments for the pair are above the line deductions if the divorce was settled before December 31, 2018. And for the recipient, these payments are taxable income. So they cannot exclude these payments, and this becomes part of their gross income. Now, for the divorces that were executed after December 31, 2018, again, we'll just refer to them as post 2018 agreements. For these divorces, for the payer, these alimony payments are not above the line deductions. And for the recipient, these are not taxable income either. So please pay attention to this date, December 31, 2018, because things changed after this date. The next thing that we want to learn about is the tax treatment of child support. This has not changed, and this has never been deductible to the payer, and this has never been taxable to the recipient. So along with learning about the tax treatment of alimony, you should be aware of this tax treatment of child support. Now, another thing that I should just briefly mention is the IRA contribution implication. For this pre-2019 taxable alimony, these qualify as compensation for IRA contributions. What that means is if you got divorced before 2019 and if you receive alimony payments from your ex-spouse, then those payments qualify as compensation. You can use those alimony payments to contribute to your individual retirement account. Now, for child support and post 2018 alimony, they do not qualify for IRA contributions because they are not earned income, they are not compensations. This is something that you should learn when you prepare for the retirement planning section of your CFP exam preparation. Now, let's look at an example. John and Mary divorced under a decree executed on December 15th, 2018. So please pay attention to that date because this is before December 31, 2018. Now let's keep reading. Requiring 6,000 per month total support, reducing to 4,000 when their child turns 18. We should figure out that this 6,000 per month total support, not all of it is alimony. And the reason is that that amount reduces to 4,000 when their child turns 18. That means 2,000 of that 6,000 is essentially child support and the remaining 4,000 is alimony. Now let's keep reading the question. It says plus 1,000 per month specifically for John's house mortgage where Mary lives temporarily. Again, as we learned, these payments cannot be alimony, so this is just a distraction. Let's read the last piece. Plus 500 per month voluntary support not in the decree. Again, voluntary payments are not alimony. So what that means is out of all this information that we have been provided, only 4,000 is alimony and the rest of it is just distraction. This example shows you something very important. That is, during your CFP exam, you might be presented with a lot of information and you need to be aware of which of the information that you have been provided with is useful and which one is just a distraction. So by reading this whole question, I should note two important things. The first thing is the divorce was settled before December 31, 2018. That means to the payer, the alimony payments is going to be above the line deduction, and to the recipient, these alimony payments are going to be taxable income. And another thing is that the alimony here is only $4,000. Although there is a lot of information, we just don't care about them because we just care about the alimony part here. So the question is asking about what is John's AGI, and to figure out AGI, if we remember the formula, we know that we need to think about the gross income, and from there we can take our above the line deduction. So let's figure out our gross income here, which is quite straightforward. We have salary and we have interest income. So there are only two sources of income if we are thinking about income broadly defined, and none of these can be excluded. So that means in our gross income, we have $120,000 of salary, $5,000 of interest income, and then we can deduct these alimony payments as above the line deduction. Now, you need to be aware of something here, and that is these alimony payments are monthly, and the tax calculation here is annual. And that's why we need to multiply this 4,000 by 12. And then once we do the math, we'll see that the AGI is $77,000. So please pay attention to this multiplied by 12 part. If you don't do that, you will get to a wrong answer here, and that might be set up as a trap. So please do not fall for that trap. And also please do not fall for the trap of unnecessary information.